Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Backett, and welcome to the show. Hey everybody, welcome back to We Build Great Apartment Communities. I have here a great guest, someone very excited to speak with today. He is crushing it out there in the mobile home space. So welcome, Ryan Murdock.
Hey, John. Good afternoon. Thanks for having me, man.
Hey, man. Anytime, man. I appreciate you being here. Hey, man. So let me share with our audience your background. I think it's going to help them understand, who you are, where you've been, where you are today, and of course where you're going with your business. So Ryan Murdock spent about 10 years in the electronic manufacturing industry before he transitioned into real estate investing and property management in 2007. He has an extensive management experience or background in many facets of real estate, including retail, office, multifamily, HOA, that must have been fun, and especially mobile home parks. And of course, now you're doing stuff nationally and you're consulting around various projects, throughout the nation. So, Ryan, you also were a licensed real estate broker for about a decade, and you now own and operate a portfolio of residential rental properties outside of, Open Door Capital, which is your current venture now. So, hey, man, welcome to the podcast. Very excited to speak with you about a couple things. And, what's new in your world? Maybe we start there. It sounds like you're very active. You have a lot going on. Where would you like to start?
We can dive into what we're doing now, which is like you had mentioned, the VP of Acquisitions for Open Door Capital, which is Brandon Turner's mobile home park acquisition and operation company. So we buy mobile home parks all across the U.S. We're targeting steadily cash flowing parks, but with some element of value add. So we're looking for parks that are 60, 70, 80% occupied, that are cash flowing and reasonably stabilized, but with that certain percentage of vacancy. So we can go in and add some homes and fill some vacant lots and add value that way through a few other means. So I've been doing that now for just under 2 years. That Open Door Capital really came together in its current form. There's I believe 9 of us now on the team. Just an absolute rock star team of individuals. Love them all to death. They do a great job. Prior to that, I'm living in Maui now for the past 2 years. But prior to that, I'm born and raised in Maine. Was in the electronics manufacturing for 10 years, kind of running all over the world. Lived in Asia for a while. Spent a lot of time in Mexico and manufacturing facilities. And when I got out of that around 2007, 2008, I just started buying real estate. Really not sure what I was doing, but bought a duplex and lived in one side, rented out the other, and then just slowly added small multifamily properties to my portfolio. Also got my real estate agent license around the same time, pretty much so that I could really just broker my own deals, right. Do my own showings, write my own offers, and that turned into its own pretty lucrative business where I hadn't intended to represent buyers and sellers, but I ended up doing that and doing pretty well with that. And then also around the same time started a real estate management company. So I was managing properties for other property owners. So just scratching and biting and clawing my way over the past 10 or 12 years. Yeah,
it sounds that way, man. It sounds that way.
Where we are now.
So why mobile home parks, right? Why the transition to mobile home parks? I can tell you're very passionate about the space. So share with our audience a little bit about, the value that you see in mobile home parks and the big why.
Yeah. So, as you know, in real estate investing, there's just so many avenues you can take. There's so many different ways to be successful. And we love mobile home parks. And as Brandon Turner puts it, like he chose that not because he necessarily thought it was the best, although we really do think it's the best. So like you just got to pick something and go with it and be the expert in that field. So that was the path. And I was well on board with that as I had many years of mobile home park management experience. So I've been down in the trenches of value add and mobile home park management. But I never really looked at it through the eyes of an investor. Even though I was an investor, I just had my blinders on, and I didn't, it just never really dawned on me that I would want to own a park. But now that we got going on these things, we really see the reason that we like them is there's a few, and the main one I touched on is that ability to add value to a park in a way that's different from, certainly different from apartments and other asset classes, where we'll buy parks that are cash flowing. We'll buy them on their current value based on their NOI. And those parks will generally do well, and we could potentially operate them that way indefinitely. But what we're seeking is that sort of park with a 20 to 30% vacancy. So we can add value to the parks by bringing in homes and setting them up on those lots. And there's a few ways we do that. I mean, ideally, we would have a tenant who would bring in their own home and set it up on the lot and just start paying us lot rent. That the movement in the industry, as far as people bringing in homes, it happens, but it's not quick enough or widespread enough that you'd be able to fill a park that way. So more often than not, what we end up doing are we're buying mobile homes, either used ones or new ones, bringing them in, getting them set up. If they're used, we're renovating them and making sure that, everything works, and the heating systems and the plumbing and electric and, new paint and flooring, and really going through and creating a nice product, and then selling that home off to a tenant buyer. And the goal there is, like, say we have $20,000 into a mobile home that it costs us to buy it, set it up, renovate it. If we sell it, even for a break-even price, or even sometimes for a little bit of a loss, it's still a win for us, because we're generating now like that $300 to $400 a month lot rent on a lot that otherwise would have been inactive and doing nothing. So, so sometimes we'll make money on the sale of a home, but that's not the goal. It's to generate that lot rent, which goes almost right to the bottom line.
Yeah. And plus you get a vested tenant, right? You get a vested, in this case, an owner tenant. You see a much higher pride of ownership in general with mobile home park tenants, because they own the home. Like you said, they tend, like an apartment tenant can pack up. They can rent a U-Haul and pack up and be gone in a couple hours. With a mobile home park tenant, they can't do that, nor do they really want to do that, because they own their home. They've got emotional attachment. They've done the repairs. They fix it up. There's you see pride of ownership and landscaping, and like they're taking care of it, so they tend to stay there longer. Okay, cool. So, man, I'm going to unpack this a little bit. All right. So inside of our cycle, real estate cycle, doesn't really matter what asset class. We have acquisitions, financing, management, and at some point we have to dispose of the asset. I like to add a fifth category in there before the disposition, which is you have to be good at running a business, right? There's a customer service component to every business. I think that's really crucial. And then, of course, just being a really good operator. So let's talk a little bit about financing this product type. Okay, so you mentioned something that caught my ear, which was you're looking to buy parks that are usually about 20% vacant. And I understand there, right? What you're implying there is that there's an opportunity to add value. The property might be a little bit undermanaged, right, to some degree. So talk a little bit about the metrics outside of the vacancy that will typically show up when you're underwriting, that will define your acquisition criteria, right?
Yeah, sure. So right out of the gate, we're looking for, we want parks that are at least 100 lots. Anything smaller than that we found is just not real efficient for us to manage in our current management structure, because we have parks all over the country. So our parks will have on-site park managers, but those people are usually fairly limited in their capability. They'll collect rent and they're just kind of eyes and ears of the park, but they're not doing a tremendous amount above and beyond that. So everything gets fed back to our management company, which manages all of our parks nationwide. So you need a certain scale. To do that with a 20 or 30 lot park just doesn't make sense. So we need at least 100 lots. We're looking for public water and public sewer. There's some great deals out there with private utilities, but we don't want to deal with them yet. We've been able to find some great opportunities just with public water, public sewer. So just by weeding that out, like that discounts a lot of the parks right there. And then in addition to that, some other variables are, I don't know how far into the weeds you want to get, but as far as like the number of park-owned homes, so that can be a common problem in the industry, where a park is priced. A seller has a park, they're offering it for sale, and they're basing the valuation on the lot rent. And if there's a lot of park-owned homes, they're getting rental income from the home itself. So it's almost two separate contracts with the lot and then the park-owned home. Well, in the seller's eyes, his park is worth, say, $5 million because he's got primarily all park-owned homes. And he's valuing his park based on the NOI from that income. The bank, however, will not give any value to the rental income on a park-owned home. They're going to discount all of that, and all they're going to value the park on is the lot rent. So when you take those two different numbers, they can be miles apart. So the seller may value his park at $5 million, where the bank is looking at it based on the value of the lot rent only. It's only worth $2 million, and they're only going to loan up to 70% LTV on that. So
why is the bank discounting the value associated, right? The income stream value associated with the homes?
Yeah, there's a few reasons, but primarily mobile homes, they don't value them as real property. They're personal property. So it's like a boat or a car, so they don't want to loan money on that because it's not real property. If it was a house that was, mounted on the land, built on the land, it's different. But these are in their eyes still too mobile. They don't want to use them as collateral for their loan. So we're looking for the greater percentage of park owned homes, the more right out of the gate we think we're going to have an issue in valuation and what we're able to do there. So with that, that's why you see a lot of in the mobile home park industry, you see a lot of seller financing because of that. Whereas the seller will hold either the entire note or maybe they'll hold the second for the value of the park on home rents and try to pick up the slack from where you can't get conventional.
Okay, cool. I'm gonna get back to that a little bit because there's some valuation questions that pop up because of that, right? Between buyer and seller naturally. So let's talk now a little bit about financing, right? So you're buying parks that roughly are 20% vacant, which I get, opportunity to add value. So how are you typically financing parks like this when there's that type of vacancy? Are you using bank debt? Is it typically seller financing? Can you talk a little bit about that?
Yeah, we a little bit of everything. I mean, it's there. We have some that are seller finance. We use just local banks where we'll get 60 to 65, maybe 70% LTV based on current income from the income that's there and current and present. If it's a higher quality park with it's maybe 80+% occupied, we can go after agency debt and go after some more lucrative terms. So it really depends on the park in terms of occupancy, in terms of market, in terms of overall condition. I wish it was as easy as just like, our one go-to lender and we just ship them the park and that's it. But it's rarely that. We have 4 or 5 different lenders that we work with pretty closely and they all excel at like we have a park that, is 75% occupied. It's a little banged up. We know it's going to be a heavier lift and we know that is a perfect fit for this lender over here. We get one that's more stabilized, we know it's a good agency lender, so we'll take it over here.
No, I think that's really smart, right? You have to have multiple capital sources, especially on the debt side, because banks, man, they'll change, especially now when they're being required to increase their capital reserves because of losses. And so their appetite will change, right? Their appetite will change.
Yeah, so and it was really turbulent, as you know, over the past few months. And when COVID broke loose, everybody kind of retracted, and there were huge reserve requirements and prepays up front, and just all this crazy stuff. And rightfully so, I get it. Like they were all afraid, nobody quite knew what was going on. Right. And it seems like over the past month or two, that stuff has started to relax quite a bit and go back to somewhat normal. I mean, none of us know what the next few months is going to bring, but at least it's gotten a little more stable in the past 30 to 60 days than it was, say, back in March earlier.
And so what are you typically seeing in terms of terms from a bank, right? When they're willing to lend on a mobile home park. So what does that LOI look like when they say, hey guys, here's our typical term sheet for what you're looking to do, 80% occupancy.
Yeah, it's all over the place, but kind of middle of the road is, if we can get 70, 75% LTV, the rate obviously is critical, but it's not everything. We might pay, a quarter or half point more if we can get maybe 2 or 3 years of interest only versus none or just a year of interest only, especially when we're trying to add value to these parks. Those first couple of years are pretty critical. So if we can get 36 months interest only, that's worth a lot more to us than say half a point of rate, from
So are you, it sounds like most of the folks that are financing your product, they're probably local community banks. Are they regional? Are they national?
Regional usually. Yeah.
Regional. Okay.
Yep.
Okay. Yep. So you probably 5-7 year term, amortized over 25 years or 30 years?
Yeah, 25. Sometimes we can get 30 years. If we can get 30 years, we like it. We don't like to do, if it's a heavy turnaround project, we don't like more than a 5-year term because the goal is on most of them, is to refinance into agency debt.
Absolutely.
So we want to avoid things that are, a 10-year term or, when you get a significant prepay penalty or defeasance or anything like that, when you know that you're going to be looking to refi. So again, it really just depends on the deal. For the shorter term, heavier lift where when we know it's a prime candidate for a refi 3 or 4 years down the road, we might take less desirable terms up front because we know that we can refi out of it without penalty. Whereas, we can secure longer term debt with better terms, but man, we're going to be really constrained when it comes time to either refi or sell.
I get it. I think that makes complete sense. So, here's a question that I'm really curious about, right? The base rate or the index is changing for agency. And so what are you typically seeing? What are banks pegging their base rate to? What is the index? Is it Is it still LIBOR? Is it prime? I mean, I see it all over the place, especially.
Yeah, LIBOR, and you're going to get over my head on this. So that's why I said we've got an incredible team. So if you want to get our underwriter on here, Walker, he's the rock star that can dive into the weeds on that.
It's okay, man. It's okay. The only reason why I asked that question, usually it gives some type of indication for how they feel. I don't want to say where the market is moving, but oftentimes an index will help give you a sense for how the bank is viewing the risk associated with that product, right? So, okay, look, man, this is beautiful because we've covered a massive amount of, I think, content that's really valuable for someone looking to get into this space in a really short amount of time. So now I'm going to transition to management, right? So we talked about financing a little bit. No, we talked about acquisitions a little bit, or acquisition, right? Kind of the criteria, what you're looking for, why. And then we kind of shifted into financing a little bit. And then now, of course, we're going to talk about management, right? So management, one of the things that stood out to me was that you said that the managers are limited on or in parks. Okay. Yeah. So I'm really curious as to how do you automate your accounting systems to aid your management company or your manager to be able to do their job without overwhelming them with technology, right? Because I've seen that happen before. Yeah. So what is your take on that?
Yeah, it's a really delicate balance, and certainly it varies per park, and a good or bad on-site manager will make or break you. So we have some that are a lot more capable than others, but we do try to streamline things to keep them as hands-off as we can on some of the more delicate things. Like, for example, rent collection. Since Rent Manager, and there's a million different softwares out there, but we use Rent Manager. That has alleviated a lot of the rent collection issues in the sense where if we can get everybody in the park or all the tenants to pay their rent online through the Rent Manager tenant portal. They go to our website and there's a portal on there. Like, now we've eliminated the need for not only the park manager to collect rent. I mean, we don't take cash anywhere, but even like collecting checks and depositing them and then making the entry into Rent Manager or whatever the software is. Like, if we can just bypass all that and the tenant goes online and they pay it, like, that eliminates that entire step. So everywhere that we're able to implement that is like, it's just one less thing now that we have to deal with. Like the park managers don't have to deal with that.
So Ryan, man, I'm really dying to ask you this question, right? Because I can tell that you guys have dialed in this business and you're constantly finding ways to improve. Excuse me. How do you find a manager? How do you find a manager how do you find managers for your parks? That's the question.
Yep, that's a great question. We always hope that when we buy a park, it comes with a rock star manager.
But not likely, right?
It doesn't always happen. Or sometimes you think it's a rock star manager, and 2 weeks into it, you're like, oh my God, this person sucks. We got to get rid of them. And that's the thing. Like, when you identify that somebody that's no good, you got to get them out of there soon. So to find somebody else, we always try to find somebody else in the park, and it doesn't always work, but like, and I'm not the one to come up with this, but you drive around and you look at like who has the nicest looking home with the nicest looking yard that's been there for a long time, who has the most pride of ownership. And ideally, that's somebody that has maybe some extra time on their hands, whether it's, a retiree that's been in the park for 15 years and, is capable. Typically it's not a full-time job for somebody. So you can have somebody that works during the day and they manage the park at night. So we always try to pull who we think is going to be the most capable resident, because it's always helpful when they live in the park. Because they know the grounds. Outside of that, sometimes we haven't been able to find anybody in the park, and it's as simple as, running a help wanted ad. Right. Just putting out your criteria. And even if they don't live in the park, sometimes we can negotiate that they'll move into the park. If we have a vacant spot or an empty home, we can put them in. That might be part of their deal, is they move into the park, or at least, worst case, we want them within striking distance, 5-10 minutes from the park. And one of their job duties is, they've got to make the rounds every day and at least stop into the park. Or if there's an on-site office in the park, if we're keeping business hours, the office is open from 10 to 5, they're at least in the office during the day. And then any after hours emergencies will ring through to them directly. So,
okay, cool. And so what are the top 3 qualities that you look for in a manager? So when you're looking to hire someone, I understand that the first criteria, right? Kind of like a lead, right? The lead, your qualification criteria would be, hey, nice, someone who has a nice yard, caring for the property, pride of ownership, right? Ideally, you're hiring from within because they'll know the area, they'll know the park, they'll know the people. I get it. But once you've identified that person, what are some of the qualities that you're looking for that may signal? There are no guarantees until, of course, they've been around for probably about 6 months, right? But that may signal that they could be a good manager or have a higher probability of success at operating inside of your system.
Yeah, they need to have excellent people skills, especially, and this is especially difficult for somebody that lives in the park because they have to be firm but fair. So they've got to enforce park rules, and they've got to deal with all the other tenants in the park in some uncomfortable situations sometimes, and enforce the rules. But they also have to live there. So it's like you might have to go over to your neighbor and tell them, hey, you got to clean up this crap that's piled up in the yard. You got to cut your grass, or, you're late on your rent. If you don't pay, here's your eviction notice. So not everybody's comfortable doing that, and I get it. So you've got to be able to balance firm but fair and enforce rules confidently, but without being a jerk, right? So they got to have that element, and that's tough to screen on somebody that you're just trying to figure out, right? Unless they have stellar references from a very similar job, like that's tough to screen out. And then obviously trustworthiness, which is another tough one to screen out in an interview. Even with no cash payment, there are ways that a manager can rip you off, and if they're responsible for. If they say we have a handyman and they're in cahoots and the handyman took 3 hours, but he's billing us 5 hours and the manager's in on it and they're splitting the money. Like there's all kinds of ways that they can rip you off. And I don't think any of them can rip us off for too long before we catch on, but it might go a few months where they're, giving us a receipt for company gas and they filled up their daughter's car or something like. So there's got to be an element of trustworthiness, and if they're doing untrustworthy things, we're gonna catch them. It's just a matter of how long. So good people skills and trustworthiness, and then like probably the toughest is just the ability to make good decisions, which is really tough.
So what do you love most about parks, right? I mean, when you think about the different asset classes and where we are today in this cycle, we have, of course, retail, office, there's multifamily, and now, we're talking about parks. So this environment, or this pandemic rather, has, I think, really changed how people view maybe risk and, of course, allocating their investments and their cash. So can you talk a little bit about that? I mean, what do you feel some of the strong points are, and some of the the weaknesses with parks as well?
Sure. Yeah, no, the strong points are, they're typically workforce housing. They're lower income housing. So I'm confident that no matter what the economy is, there's always a need for that. In an up economy, down economy, like there's always a need for lower income housing. If we were into, high-end luxury apartments, I think those are a lot more volatile, maybe a lot more high, but also a lot more risk for lows in a bad economy. But workforce, low income housing, there's always a need for it. The other thing is we're not over leveraged on our parks. So no matter what we're underwriting, we're never leveraged at 90 or 100% LTV. So there's always some room to move there. And then even if our calculated exit is, say, 5 years, and who knows what happens with the economy in 5 years, we're buying everything so that it cash flows right out of the gate. So maybe we can't exit in 5 years because the economy is terrible and the values are down, but we're okay. We can sit on it for 8 years, for 10 years maybe, and just lay low until the next market cycle. So the fact that we're not hedging on absolute value add in order to at least break even or turn a profit gives me a lot better reason to sleep at night. If it was 100% a value add project and like with a higher end, say, apartment deal where you have to go in and you're getting rid of all the tenants because you're going in and you're turning these from a C-class apartment to an A-class apartment at a cost of $20,000 per unit, and you got to raise the rent $400 a month. There's a lot of money to be made that way, but in my eyes, it's a lot riskier, right? I mean, you're a lot more chained to what the economic cycle is, where the sky falls. We can lay low in a mobile home park, and just as long as we can collect rent, we're going to be fine. Okay. So I like that, and I can see that, right? I can see where you have typically a lower LTV because you're usually buying in with 20% vacancy. And so in theory, there's some embedded equity in there as long as you're able to create that value by filling those units, right? Filling those lots, if you will. So I'm going to transition to more of a question.
but also an observation, right? And so you're going to appreciate this because, you're in this business now, you're buying parks, you're dealing with people, you're managing people, you're leasing up. So I have two friends, okay? And both of them, very different ideas around what they like to invest in. One of them loves parks. The other says, man, you will not see me investing in a park. And so when I ask why, the reasons are very different, but kind of interesting, right? One echoed some of the things that you said. The other's like, man, I just don't like dealing with the people. Okay. So that's one of the big, I would say that's the feedback that I commonly get. How would you respond to that, right? Because not to say that that's always the case, but I hear that feedback quite a bit. Okay. And maybe it's a stigma. I don't know. But both are very sharp guys. Okay. Very smart investors, but they just have their own preferences. So what are your thoughts on that?
Yeah, number one, I think there is a sort of undeserved stigma around mobile home parks. I mean, I get it. I agree. Trailer Park Boys, the show, I love that. I mean, it's hilarious. I love the whole thing. It's a riot. But I think the reality is, of course, there's a certain element of that. Yeah, and we've looked at parks, and we'll pass on a lot of those parks that we're just like, you know what? This thing is hopeless. Like there's no way we're going to be able to.
There's no coming back, huh?
There's no coming back. It's gone. It's one of those. But I think also in the apartment space, there are those.
Sinking
right?
submarine.
Yeah, no. I mean, I've managed apartments and I'm aware of apartments. Same deal. Like they're just unsalvageable. Like it's not worth the time, money. They're always going to be crappy. You're always going to attract the people that you don't want to attract.
I get it, man. Sinking submarine.
But I think like with apartments or mobile home parks, like the right ones are always salvageable, and a lot of our parks that we buy, part of the value add sometimes is, I mean, like anything, you could have 100 good tenants. It only takes one to drive you crazy and keep you up at night because they're just doing God knows what, right? But we go in and we quickly identify those people that aren't paying rent, that are dealing drugs, that are causing problems, doing whatever. Get rid of those people. Get rid of them, evict them, like get them out. Same thing you would do in an apartment. Get them out of there, replace them with normal functioning people, and the whole community improves because now like the good people are not alienated by the bad people. So it's definitely a personality. Your friend that wouldn't like mobile home park because he doesn't want to deal with the people. I think property management in general. I don't care what asset class it is. If it's residential, it's commercial, it's whatever. Like. It's not easy. It's hard. And if you don't have the personality type that can manage property, regardless of what it is, you shouldn't be doing it.
Yeah, that's a great point, man. That really is a great point, Ryan. I mean, I think what you said carries a lot of truth, right? A lot of truth because the reality is no matter how you buy an asset, you can buy an asset at a great price, buy into a great deal. But when it's all said and done, if you can't execute on your business plan, right, to get that thing leased up or whatever the requirements are, especially long term, the value is not there. You don't create that value. In fact, you actually lose value, right? So I agree. I think that's a very good comment.
Yeah, and it doesn't mean you can't invest in real estate. Just don't manage it yourself. Like build it into your business plan that somebody else has to manage it. And I think, I've managed real estate from high end, low end, everything in between. And I think hands down, the toughest personalities and people that I have ever dealt with wasn't in the mobile home parks. It wasn't in the C&D class apartments. It was in the nicer HOAs, the condo associations,
really?
Hands down, like the
why do you say that?
I'm not saying they're bad people. It was just that's the toughest person-to-person management that I've ever done. I would take a war zone mobile home park over some of the HOAs that I've had to deal with. Just the sense of entitlement for someone. And I'm not trashing.
Yeah, I was thinking that. I'm not
trashing. But so all right. For example, if you're dealing with an HOA board, for example, and I'm generalizing, they're not all bad. I had some great interactions, but some of the toughest challenges were with HOA board members who, keep in mind, most of the HOA board members now it's a volunteer position. So like you're getting people that are volunteers. So that's a challenge. And a lot of these people that are volunteers have zero background in managing sometimes what are multi-million-dollar budgets on, wide expanse of, 50 plus acre properties with hundreds of units. They have zero experience doing this, but they're making financial decisions on this from emotion, off the cuff. Like it's tough to argue. But the problem is because it doesn't pay anything. Because
it's so true, man. It is so true.
Yeah. The people that are qualified and that you would love to have on that board are not doing it because they're out doing something else, making money, right? They're not the little old lady who's super emotional and makes her decisions that way, but is on the board because she has nothing else to do and it's her way to stay involved, right? I mean, so that's very, very tough. That for me, some of my biggest challenges in management are, I mean, I would rather go into a guy that's stealing drugs in a mobile home park, lay down the law, serve the notices, get him out of there, like however you got to, and like I have no issue doing it. Yes, it can be stressful, but 1, 2, 3, here's what's going to happen. You're out. We're moving on. But HOA, man,
that's classic,
that's
man.
Tough. So, yeah.
Well, okay. So let me shift a little bit. Okay. Cause we're coming to the end of the show, but share with us your most profitable deal, right? I mean, talk through, you don't have to give, super details, but just to give, we're going to do the most profitable and one that was the least profitable. And the idea there is to share the lesson learned, right? Because oftentimes the lessons they come in many different forms. So can you walk us through a story with a profitable deal, greatest lesson learned, why that deal was profitable? If you could do it over again, what would you do? And then same thing with your least profitable deal. You're on the acquisition side, so you see a lot of different things.
Yeah, and so as far as my personal portfolio, I'm a buy and hold, so I don't have a lot of victories of where I sold stuff off. I've done a lot of refis and cashed out, which I like. And then with the mobile home park space, we've certainly added a lot of value through infill, but only 2 years in, we haven't disposed of anything yet. So I don't have a great hey, we sold this for 5 times what we paid for it. But just as a quick example, we've got a small park in Maine. I love to use this example because it's an easy one. It's a 50-lot park. We bought it for just about $1 million. It came with, there were 36 or so homes. 10 of them were vacant. There was another, 10 or 12 or 14 vacant lots. And over a 2-year period, we demoed the homes that were absolutely junk. We renovated the ones that were salvageable, sold them off to tenants, right, and then hauled in enough homes to fill that park out. So in the past couple of months, we've filled it, and we brought the NOI. I think when we the first month that we acquired it, the NOI was like $7,000 or $8,000 per month. And then I just ran the July reports for last month, and we're up over like $35,000 NOI for 1 month. So and we were taking the value of that park from $1 million to, if you had to value it today, it'd be probably 1.8 on paper, maybe 1.6, 1.7 if you actually wanted to sell it. So I mean, that's just a great short-term example of what you can do just through the power of infill. I mean, that's a great one. And then obviously we have more complex deals that we're buying now, but the principle is the same. And the percentage return is the same. It's a great strategy. As far as catastrophic deals, mercifully, I haven't bailed on any that I had to write a big check at closing, but I will tell you, there have certainly been some stressful times. And I think the most stressful was a result of me personally. This is pre-Open Door Capital days, around 2011. I bought a 20-unit multifamily portfolio, seller financed, and had run all my numbers. And really, I didn't have any money at the time. I mean, it was almost entirely seller financed. And the way I had underwritten these things, I was going to hit the ground running, and they're going to cash flow from day one, and things are going to be great. And that was not the case. I ended up, long story short, I had to evict a bunch of people, and they trashed the units, and there was a lot of CapEx stuff that I didn't pick up on. And, I ended up putting about $100,000 of my own money, which I didn't have. I was putting on credit cards and just all kinds of crazy stuff. And that took me 3 or 4 years to dig out of that. And there was a time when I didn't think I was going to make it. There was one day I was like, I'm going to lose that. And because I put all my other money into it, I'm going to lose everything I have. And really, really stressful. But I was able to dig out of it. And I still have that property today. It's great. It performs like I thought it would 10 years ago. It just took me a few extra dollars to get it there. But my point, my lesson for that is just don't be undercapitalized. Make sure that you have money to cover whatever the repair is. So if you're buying a small property, that's probably a smaller reserve fund. Anybody pretty much, if you got a duplex and the furnace goes out, you got to fix that today if it's cold. You can't wait. So in a desperate situation, almost anybody can probably scrape together $5 or $10 to cover that if they absolutely had to. Might not be comfortable, but you could do it. But the bigger the property, the bigger that potential problem becomes. So if you're buying a 40 or 50 unit apartment complex and you have zero reserve money and something goes wrong, not everybody can scrape together, $40 or $50,000 for that heating system.
I get it, man. You
gotta make sure you're capitalized.
That's great advice, right? Great advice. So anytime we buy something, man, we fully fund all of our deals. Fund them every single time. Yep. Fully loaded cost, right?
Yep, you have to. Yep, and then maybe throw in an extra 20% for whatever you missed still on top of that.
Usually it's already baked in. Usually that miscellaneous margin is already baked in.
Yep. Yeah, we do the same thing. We have to. And I think making those mistakes early on was a lesson for, preventing me and certainly anybody else from making bigger mistakes down the road.
Right.
The sooner you can trip and fall down, the less you're going to do that on a bigger scale later in life.
Well, hey, man, you've been a tremendous guest. We're at the end of the show, but man, you've been a tremendous guest. Great information. I'm just going to recap, right? Because we walked through the entire cycle in literally under 40 minutes, which is great. So we talked a little bit about acquisitions, the criteria that you're looking for and why. We shifted into the financing portion of that. We didn't talk about equity. We talked about debt. The equity is coming from your fund. But we talked about debt using, in this case, you folks are using mostly regional banks, but it sounds like community and regional banks are going to be your sources on debt, the debt side, right? They're financing at terms of 5 to 7 years, balloon with amortized over 25 years, maybe 30 in some cases. And your takeout lender is, sounds like you're looking for agency debt.
Yes.
Expensive debt, predictable, right? There's a guarantee there, so they're active in this marketplace. Then we shifted into management, which is awesome because perhaps one of the most difficult things to master inside of this space, but also one of the more profitable if you can get it right. So you gave us some great tips, man, on what to look for in a manager. Number one tip is find a person who's showing love in the community, right, to their own space. And that's usually a great starting point. And a couple things that you mentioned to look for was really the number one thing was their ability to deal with people, which is a really big deal. But there has to be a balance between being able to deal with people and be customer service oriented and getting people to follow the rules, right? And that's kind of the tough combination. So very, very cool, man. And then lastly, you talked about some of the reasons why you love this space, okay, which I find pretty cool. The other side of this, though, is one of the negatives, which I think in many cases is just a bad rap or a myth, which we talked about that, right? This industry can tend to develop a bad myth, but to your point, that often comes down to that person's ability or willingness to want to manage or bring someone else in to do that. So, man, look, this has been a great conversation. Really appreciate having you on. You've been a tremendous guest. And man, I wish you continued success. How do people get a hold of you, Ryan, if they want to learn more about what you do and how you do it?
Sure. You can check out me and our entire team at odcfund.com. So like opendorcapitalfund.com. You can email me directly, Ryan, RYAN, at odcfund.com. And then you can hit me up on Instagram. I'm at Ryan.Murdock21. And I'm also pretty active on the Bigger Pockets forum. So any of those ways, you can reach out to me. Beautiful, man. Beautiful. Hey, man, thanks so much. Again, really appreciate it. And look forward to learning more about your successes and having you on when you get to $100 million. All right, man. Thanks so much. I really appreciate it. You're very welcome, man. Thank you. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Backett, bringing you things you can implement right away.